Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Let's look at the global situation currently. The situation in the Middle East continues to remain volatile. While a ceasefire was agreed upon in the first week of April, there is no major breakthrough in the last 2 months. While there have been back and forth talks between US and Iran on a potential deal, it still remains elusive. Markets have been jumping up and down depending on the news flow both from Iran and US. While the US wants Iran to give up nuclear weapons and any form of nuclear enrichment, Iran is not agreeing to that compromise in the deal which is being discussed. Many other points are on the free passage through the Strait of Hormuz, which Iran discovered that he can control. While Iran has been blockading the Strait of Hormuz and trying to get some control of the flow through that strait, the US has been blockading the Gulf of Oman and not letting any Iranian ships through. This has led to elevated energy prices, especially oil and gas, which continue to hover around $100 a barrel. After ceasefire, there was a sharp drop in oil prices, with market assuming that quick US and Iran deal will happen and that will lead to lower prices. However, the back and forth between the two countries has led to volatile oil prices, with the Brent oil swinging between around $90 to $110 per barrel in the last few months. Overall, the situation continues to remain grim and possibility of a deal remains still out of reach. In the recent past, US has further extended, in consultation with Iran, a ceasefire to another 60 days. That means the US and Iran will have another 60 days to conclude their deal on the nuclear issue. There will be other issues, but this issue of nuclear power remains the most important both to Iran and the United States of America. Markets continue to remain volatile. While equity markets in US have been going up, driven by the AI mania, other markets continue to remain volatile, especially in Asia. In India also, markets have been moving sideways depending on news movement. In the rate markets, we have seen a jump in US yield, primarily driven by higher oil prices, but also that the fiscal deficit in US is unlikely to come down in the near future as defense spending ramps up and US administration demanding more funds from the Congress for further expenditure. The AI fight between US and China also has led to more expenditure on both the sides. Rates in other countries, including developed markets, also have been edging higher on oil prices, and also as Europe and Japan both pick up pace on defense expenditure. In India, situation remains a bit volatile. Prior to the start of the war, the Indian economy was in the sweet spot where inflation was at a lower level, less than 4% of RBI's target, while growth continues to remain strong at above 7%. However, post the start of war, oil prices jumped and that impacted India in a big way. India imports almost 70 to 80% of its oil requirement from overseas, with the Gulf region being a major supplier of both oil and gas. With the disruption of supply, there was increase in prices across the world. However, India chose not to pass on the fuel prices in the early part of March and April. Now that the prices had been passed through, we have to wait and see how it impacts inflation. Inflation number was 3.5% in April, which was well below RBI's target. However, now with the almost 7.5% increase in fuel prices, we should see some impact on CPI inflation. Already global inflation is now seen in the wholesale price index at 8.2%, which is the highest in last 3-4 years, reflecting higher oil prices as well as other commodity prices. Rupee depreciated sharply in the aftermath of war, with the USD INR climbing to almost 97 rupees to the dollar in the past few weeks. RBI has been active in the market to reduce volatility, but with large outflows, especially on the equity sides, and larger outlays probably required for crude imports, we could see rupee remaining under pressure till the oil prices come down from the current levels. Rate markets also followed global rate cycle. We saw 10-year climb to above 7% from just around 670 to 6.80 before the start of the war. Government borrowing remains under control. However, there is risk to higher fiscal deficit on back of higher oil prices, which typically may lead to higher oil subsidy as well as fertilizer subsidy. While the government has increased prices of petrol and diesel in the past 2-3 weeks, gas prices, especially if we look at domestic LPG prices, have remained more or less constant in the past 1 month. There was a mild increase in the early part of war. This could mean a higher subsidy bill for the government in the coming months. Currently, the oil marketing company are taking the brunt of the higher input prices without passing on them to the consumers. The situation is currently not clear how much government has to pay if required on the subsidy bill. The longer this situation continues, where there is an uneasy truce between US and Iran and the Strait of Hormuz remains choked, oil prices will continue to pressure Indian economy. RBI is expected to remain on hold in the upcoming policy meeting, adopting a wait and watch attitude as more data flows in and the full impact of energy prices has been passed through to the consumers. RBI will look at how this reflects on the inflation as well, how much pass-through is happening to the core inflation as well. Generally, central bankers try to look through supply shocks impacting primary articles like energy prices, but they would like to act if they see a pass-through happening through the secondary and tertiary prices, which can lead to higher inflation expectations. However, with rupee under pressure as well, RBI may be forced to act earlier than required. We have to wait and see as and when RBI gives guidance on any rate hikes in the future. The monsoon situation also remains grim, with the Super El Nino being predicted in coming months. This could impact rainfall in the early part of June and July, which is the sowing season. This could adversely impact food prices going forward. However, government can take action and release stocks from the buffers to manage the food prices. This could further complicate RBI's policy making, and we have to wait and see how RBI handles the whole situation. Overall, rate markets continue to show an upward trend. We expect rates to remain under pressure in the coming months and continuously watch the global developments. Any indication of an early end to war could lead to reversal of the current trend and could bring down rates a little bit, giving comfort to the markets. Considering the current situation where inflation is expected to inch upwards and a current uncertain global situation, rate markets are likely to behave erratically. Investors may choose to invest in funds like ultra short-term fund, low duration funds and short duration funds. As usual, investors should look at their risk appetite as well as their investment duration before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.